Aloha, this is Kurt Nielsen at eMortgage Hawaii, and today we've got some good news. And the good news is about mortgage rates. So let's get started here. Over the past 45 days, we've seen a rapid decline in mortgage rates. And the question is, will it continue? What's driving this? And what are the factors that we're looking for in the future? So the mortgage-backed securities market is really a bond market. As the prices go up, rates go down. Since October 16th, rates have been just dropping dramatically. And the question is this a fluke? Should it continue? What's going to drive this? So if we look at a rate quote from October 16th to November 28th, let's say we had a purchase price of 1.2 million and a loan amount of 900,000, a good FICO score. That rate on October 16th was 8.25% with a small fee. Today, or on November 28th, that rate was 6.875. So that's about a 1.375% drop in rates over a 45-day period. That's pretty dramatic. So really, what is driving this? As we always say, inflation and mortgage rates are tied together. As inflation went up, mortgage rates went up, and now inflation is coming down and mortgage rates are coming down. But let's dive into inflation a little bit deeper to see what components are important to us. The most important factor is shelter cost. Shelter is 44% of the consumer price index, and it really shot up, during the COVID period, but it has come down dramatically, and it's expected to continue to decline. But if we look at the core CPI is showing shelter cost at 6.7% year over year, because it's a 12-month lagging indicator. It looks back over the last 12 months, but the real month to month, it's only at 2.6. So there's a dramatic difference between this. And that's the problem with the Federal Reserve, is they're looking kind of backwards at this trailing lagging indicator. If we were just looking at today's shelter cost inflation, it would reduce the core CPI all the way from 4% down to 2.2%. So all we have to do is kind of sit back and wait for those old numbers to fall off, and CPI will keep coming down as long as something doesn't drive inflation back up again for any reason. Another factor that we should consider is the spread between mortgage rates and the 10-year Treasury. It's pretty much around 300 basis points right now, or 3%, but the normal spread is usually around 1.75% to 2%. Now, why is this so different? And the reason is because the Federal Reserve is doing quantitative tightening, where they're removing about $100 billion a month out of the money supply. When they stop doing that, we expect that spread to get a little bit smaller, and all of that will be benefiting mortgage rates. So the question is, will the Fed stop the quantitative tightening? They have to at some point, and we're expecting that in the first or second quarter of 2024. So what's our forecast? CPI will continue to decline with sharply lower shelter cost and sharply lower oil prices. The labor market appears to be slowing. Next report is on December 8th. It's just over a week away. And the November CPI report will be out on December 12th. And we're expecting that to continue to drop because of shelter cost. And then the Federal Reserve is making their rate decision on December 13th. So we have a busy couple of weeks ahead of us. And we expect no rate hike, and maybe even some discussion about when will the Fed start lowering rates, maybe in the first quarter of 2024, maybe the second quarter. But if they do decide to lower rates, they first have to stop quantitative tightening. You're not going to start lowering rates while you're still tightening the money supply. That wouldn't make any sense. So we do expect mortgage rates to continue to decline. It's not a straight line effect. It bounces around a little bit. If the Fed ends quantitative tightening, the spread on the mortgage rates will drop, and that'll reduce mortgage rates an additional 1 to 1.25%. Now, remember that these lower mortgage rates will bring back on-the-fence buyers and will increase demand for housing, which will continue to put pressure on housing prices because we're just not building enough homes fast enough. So the time, I think, now is to buy now before the new wave of homeowners enters the market. So there you go. I hope you gathered something from all this. We're going to be updating you after the Federal Reserve meeting in December, because we expect that the next 2 weeks to be an important move in the mortgage market. So give me a call if you have any questions, you have any buyers that need to get a rate quote or get pre-qualified. Thank you very much.